Today, we explore the critical foundations of pairs trading, mean reversion, and stationarity. Grasping these concepts is crucial because they underpin the strategies used by traders to capitalize on predictable price behaviors. First, consider stationarity. A process is termed stationary if its statistical properties, like mean and variance, remain constant over time. This predictability makes the process inherently mean-reverting, which implies that it tends to return to its average value over time. Contrarily, many financial time series are non-stationary. They lack a constant mean and variance and are theoretically unpredictable. However, pairs trading offers a unique angle because it creates an artificial stationary series by strategically combining two non-stationary time series. It's important to differentiate between mean reversion and stationarity. While mean reversion indicates that price deviations will eventually revert back to the mean, stationarity involves a broader mathematical framework that ensures the process's variance does not expand endlessly over time. Let's discuss a practical tool in our analysis toolkit, the Augmented Dickey-Fuller, or ADF test, which is pivotal for assessing if a time series is stationary. It specifically tests for the presence of a unit root. If found, the series is likely non-stationary. The ADF test uses an equation where the change in the series at time t is a function of the series value at time t-1 plus adjustments for trend and cyclicality over time, captured by specific coefficients and a lagged series of changes. In simple terms, the equation looks at how much the change today, delta yt, is influenced by the value yesterday, yt-1, plus a trend component and past changes. The test checks if these relationships are statistically significant to conclude if the series wanders like a random walk or has predictable patterns. Next, we consider the Hurst Exponent, which helps assess the degree of mean reversion in a series. It indicates whether a series diffuses slower than a geometric random walk. If we describe it verbally, the variance of the differences in the series over different time lags is expected to scale with time raised to the power of 2 times the Hurst exponent. For a typical random walk, this exponent is 0.5, meaning the series diffuses proportionally to time. If the Hurst exponent is less than 0.5, the series is more likely to revert to the mean, suggesting predictability. The half-life of mean reversion is a key metric indicating how quickly a price series returns to its mean. From the Ornstein-Uhlenbeck process that models price changes as a function of the previous price, plus a mean level shift and noise, the expected value of the series at any time t can be described as starting from an initial value and decaying exponentially towards a long-term mean, adjusted for any trend. The half-life is the time it takes for this process to have any deviation from its long-term mean. It's calculated simply as the natural logarithm of 2 divided by the absolute value of the decay rate, lambda. Finally, let's discuss cointegration, which identifies stable, long-term relationships between two otherwise non-stationary series. If a linear combination of these series results in a stationary series, they are said to be cointegrated. Practically, this is explored by regressing one series on another and examining the residuals. If these residuals form a stationary series, the original series are cointegrated, suggesting a predictable long-term equilibrium relationship useful for trading.